Okay, so you want to own an insurance company. You've seen the pitch. People pay you every month. Most of them never file a claim. The money just sits there, growing, while you sip coffee and watch it compound. Simple business. Collect premiums. Pay out less than you collect. Keep the difference. Here's where most people stop thinking. Because that simple business, the one where you sell peace of mind and pocket the spread, is not the business that actually exists in 2026. The real business is a bet against the sky, the ocean, and the courtroom. And the biggest twist? The product you're selling isn't protection. It's something else entirely, and almost nobody says its name out loud. Let's start with the size of the prize. The global insurance industry grew to roughly 6.9 trillion euros in premiums in 2025. That's larger than the entire economy of Japan. The United States alone writes $3.76 trillion of that, nearly 4.5 times the size of China's market. Still the biggest single country on earth for this business. You haven't paid a single claim yet, and already you're standing inside one of the largest pools of money in human history. Now here's the part that changes everything. You don't actually make your money selling insurance. Not really. In the US, the combined ratio, the number that tells you whether an insurer profits from underwriting alone, is expected to hit 99% in 2026. That means for every $100 collected in premiums, 99 goes right back out in claims and expenses. $1 left. On the whole industry. That's not a rounding error. That's the entire underwriting business, barely breaking even, on purpose, most years. So how does anyone get rich doing this? Float. That's the answer. And it's the answer nobody puts in the commercial. Here's how it works. You collect the premium today. You don't pay the claim until later, sometimes years later. In between, that money is yours to invest. Warren Buffett built an empire on this exact mechanic. Berkshire Hathaway's insurance float sat at $176.9 billion as of early 2026. Not revenue, not profit. Money other people gave him that he gets to invest before he has to give any of it back. And when the underwriting itself breaks even or better, that float becomes what Buffett called better than free money. People are literally paying you to hold their cash. You wanted to sell peace of mind. What you actually built was an investment fund wearing a raincoat. Now here's your first real pattern interrupt. Because the sky, the one you're insuring against, stopped playing fair. Global insured losses from natural catastrophes crossed $100 billion for the sixth straight year in 2025. Total losses, insured and uninsured combined, landed near $224 billion. The Los Angeles wildfires alone caused something like $40 billion in insured losses, the single costliest wildfire event ever recorded anywhere on the planet. Severe storms added another $50 billion on their own, without a single hurricane needed to hit that number. This isn't a bad year. This is the sixth bad year in a row. You'd think insurers would just raise prices and move on. Some tried. It didn't work the way you'd expect. State Farm, California's largest home insurer, paused new applications entirely in 2023 and non-renewed roughly 72,000 policies. Allstate stopped writing new homeowner policies in the state too. In Florida, 16 insurers went insolvent since 2017, and 16 more walked away completely. Citizens, Florida's insurer of last resort, ballooned to 1.41 million policies at its peak in 2023, essentially becoming the private market's overflow tank because nobody else wanted the risk. That's the twist nobody puts in the pitch deck. In this industry, your biggest threat isn't a competitor stealing customers. It's the weather deciding your entire state is uninsurable. But don't get too comfortable in that story either. Because the market is already clawing its way back, and the way it's doing it should make you a little uneasy. Florida stripped out one-way attorney fees and assignment of benefits abuse in late 2022. That single legal change, more than any storm, started turning the market around. Citizens dropped from 1.41 million policies to around 336,000 by early 2026, a 76% reduction from peak. Rates in Florida are now falling for the first time in years. Reinsurers, the companies that insure the insurers, came back into the state cheaper and more aggressively once the lawsuits dried up. You thought this business ran on actuarial tables and weather models. Turns out it runs just as much on state legislatures and courtroom rules. Now let's say you skip property insurance entirely. Let's say you build the sleek, modern, tech-forward version instead. The app, the chatbot, the company that promised to make insurance feel like magic. Here's a number that should stop you cold. Lemonade's AI system, nicknamed AI Jim, now settles some claims in about 2 seconds. No human involved. By late 2025, 55% of all Lemonade's claims were fully automated start to finish. 96% of first loss reports required zero human touch. Across the industry, straight-through processing rates jumped from 10 to 15% up to 70 to 90%, and underwriting that used to take 3 days now takes 3 minutes. The global insurtech market is projected to hit $23.5 billion in 2026 alone. Sounds like the future arrived on schedule. Except speed cuts both ways in this business. Faster claims mean faster payouts. Faster payouts, done carelessly, mean faster losses. Lemonade posted a Q4 loss ratio of 63%, higher than the year before, even with all that automation running underneath it. You can pay a claim in 2 seconds. You still have to have priced the risk correctly in the first place, and no chatbot has fully solved that yet. You thought you were entering the insurance industry. You actually just walked into a race between two forces, speed and discipline, and only one of them keeps the lights on long term. So which insurance company do you actually want to own? The old-school underwriter, sitting on a 99% combined ratio, praying the float grows faster than the claims do? The catastrophe-exposed regional player, betting an entire state's legislature won't let the lawsuits bury you before the reforms kick in? Or the AI-native disruptor, settling claims in 2 seconds and hoping the algorithm got the pricing right before the bill comes due? Here's what nobody tells you at the start. All three of these businesses are really the same business. And none of them are really about the insurance. Go back to that $176.9 billion float for a second. Compare it to the $1 per 100 margin sitting inside the combined ratio. That gap tells you everything. The underwriting almost doesn't matter, as long as it doesn't actively lose money. The real profit engine sits somewhere else entirely, quietly invested, compounding in the background while everyone argues about premiums and claims out front. That's the real product being sold in this industry. Not protection, not peace of mind. Access to a permanent, ever-refilling pool of other people's money, held legally, invested patiently, released slowly. And that pool, unlike a drone or a car, can't be destroyed by a single bad quarter. It can be drained by bad underwriting. It can be frozen by regulators. It can be wiped out by a $100 billion wildfire season nobody priced incorrectly. But when it's managed with discipline, it just sits there, quietly working, for decades. The way Berkshire's float grew from $39 million in 1970 to $176 billion today. So here's the real twist waiting at the end of this story. Owning an insurance company was never really about insuring anything. It was about becoming the custodian of a river of cash that flows in faster than it flows out, and betting your own discipline against the weather, the lawyers, and your own algorithms, all trying to drain it before you can invest it properly. The premium checks look the same, no matter who's cashing them. The float, the risk selection, the regulatory climate, that's decided somewhere else entirely. You wanted to sell protection. What you actually bought into is a decades-long bet on other people's money, with the sky itself as your biggest, most unpredictable shareholder.